Get going. Asset Value are trying to log in at the moment, and I think they'll be with us very shortly. But in the meantime, I've got the news to cover. Obviously, things are a bit strange this morning, but we thought we'd plough ahead anyway, since we've sort of advertised this and everything was arranged. Obviously, we're in a bit of a somber mood here, as you might expect, but I think we have to carry on. So the news that I wanted to highlight this week, we've got a new IPO, the first one that's been put forward for quite some time now. And also, as you'll all be well aware, there's a lot going on around energy prices, and I just thought we'd have a look at how that might affect the UK renewables. So starting with Welkin China Private Equity, it is going to be a premium listed fund on the main market, but one of the strange characteristics of this offer is that they're not bothering to make any kind of offer to retail investors. And I don't really understand the rationale for that, to be honest. But so if you're an institution, you'll be able to access it via a placing. It may be that your broker that you invest with may be able to get you access to it if you are keen, but obviously there's something you have to make your mind up once you've read the prospectus. It's going to be a Guernsey domiciled fund, and again, that's we haven't seen many of those for a while, but obviously suits their structure. It's two currencies, so you can deal in dollar shares or sterling shares, and they're essentially the same thing. There's not two separate pools of assets. They're targeting $315 million, so 300 million of cash, and then 15 million, which they want to issue in exchange for a part of an initial portfolio. I'll explain a bit more about it in a minute. And the authority that they've taken allows them to issue up to 1 billion shares or C shares between now and the AGM in 2027. That is quite a long period. I think that's the longest period I've seen for any kind of authority, share issuance authority. Perhaps it just makes sense to do that. I'm not sure whether it's something that shareholders will be keen on or not. So this was all announced early this week. We've now put the prospectus up on our website, so you can access it through that if you want to get hold of it, because normally these things are quite difficult to get hold of. The placing will be done and dusted 26th, 27th, and the result will be announced on the 28th. And then if things will go according to plan, it will be admitted for trading at the end of the month, 30th September. I think the name tells you what it's going to invest in. So Chinese companies, unlisted Chinese companies. And the slightly strange thing is that it's got sort of a mixture of what it calls growth investments and tactical investments. So the growth investments are normal private equity investments. So new commitments to new deals, if you like. Some of the money would be invested through Welkin managed funds, so they might set up a limited partnership fund that this fund would invest in. The fund may also invest in direct co-investments, so where the LP fund makes an investment, this one might buy some stake in the company alongside it. They might also buy funds managed by third parties, and they might also buy third-party co-investments as well. But it takes quite a while to deploy that sort of money. So in the meantime, they've got this tactical investment portfolio. And the idea of this really is, as far as I can make out, is to buy secondaries. So basically pre-existing deals that have been done in the past, they buy them once they're relatively mature. So that means they'll have a much more balanced portfolio of mature investments, and it should allow the NAV to start moving a bit earlier than it would do if it was just going to have a lot of cash and then slowly drip into the market. Is that authority to issue shares until 2027 even legal? Yeah, it must be. They would have done the homework on that. I'm not sure. I think it might be something that's legal in Guernsey and not in the UK, though, because I haven't seen it before. So it might be something to delve into when I've got more time. So Welkin's been around since 2009. It's sort of supposed to be backed by people that have been setting up Chinese companies for a long time, sort of well-connected families, it says. It's got about $500 million of assets under management, and that's not a huge amount, to be fair. And if this fund achieves the sort of size that they want to get it to, we've got this will account for most of the assets under management. I think in a way that might be a good thing, because it would concentrate their minds on this rather than the rest of their business. But we'll see. I mean, it might be that the relative experience puts you off. You might want one reason to wait and watch to see how it goes. They say now's the right time to do this because Chinese equities have been a bit of a disaster recently. And that's the sort of thing that I agree with. But persuading investors to part with money to invest in something that's not been performing very well is normally a bit of an uphill struggle. So we'll see how that works in practice. We've still got the situation in China where they're trying to do the zero COVID policy. And that means that they've just done it now. They're with Chengdu, which is an enormous city, and they've locked that down, just as with having an earthquake, it's turned out. That is causing huge disruption to the Chinese economy still. But they've got a problem in that their vaccines don't seem to work very well. So they can't really open up the way that we have. And unless they sort of fess up to that and use Western vaccines, I don't necessarily see a way out of that. So China might be under the cosh for a little bit longer. They do say there's a pipeline, which is obviously a useful thing to have, but more important actually probably is a seed portfolio, because we've got no idea how big this thing's going to be at the beginning. So this seed portfolio might be de minimis, but they're looking at the $15 million share swap thing that we were talking about before, and also potentially a $15 million cash investment into this fund, this existing fund, which is Welkin Fund 2. So that's a fund that's been running for a while, already got some investments. It's got 10 underlying investments in there already. And if you go into the prospectus, it actually details them and what they're doing. It's a big range of different kinds of businesses. It will publish quarterly NAVs, like a typical private equity fund. It had a facility to gear, but that's not really part of the normal structure. I think that's quite a useful thing to have with your private equity fund. You've seen most funds now run with a kind of overcommitment strategy where they commit to invest more money than they actually have, and that's because they're trying to reduce the cash drag element of that. And the safety valve and all of that is to have a revolving credit facility, so that if you really have to, you dip into that credit facility, but typically you don't use it. It's a growth kind of play, and so they're not expecting much of a dividend. That's understandable, and it's not something that I'd be encouraging until they've got a mature portfolio anyway. The initial expenses are capped by the manager at 2%, so your pound or dollar investment will be 98p98 when it first goes in. Ongoing charges are high-ish, not the end of the world, 1.8%. Most of that is the management fee, which is 1.5%. The thing that I'm really not sure that I like is the performance fee. So it's a straightforward 15% of returns, subject to them achieving an 8% per annum hurdle. So providing they produce 8% every year compound, they're going to take 15% of all the returns, not 50% above 8%. And that's based on the NAV. And this is the chrysalis situation, because you'll be able to take a performance fee on unrealized gains, which is not particularly helpful if the NAV then goes back down again. So that's Welkin China. UK renewables. We've sort of talked about some of this before, so I'll sort of skip over some bits to assume there's some kind of knowledge. But as we know, the NAVs are all based on discounted cash flows, and so changing the assumptions to the NAVs can make quite a big difference. One of the things that's definitely happening is that the planned corporation tax hike is not going to happen. So that's going to be reversed. I'm still not entirely sure what it's coming down to, because everything on this, the policy detail is a bit lacking. But to give you an idea, when Bluefield Solar was trying to work out what the impact of its NAV was on the planned hike in corporation tax from 19% to 25% in 2023, they took about 2% off the NAV. Some funds it was more than that. Some funds it was slightly less, but that gives you sort of an idea. So basically, the fact that the government have announced that corporation tax is not going to get hiked, and that's what was built into NEVs. That will boost NEVs, so NEVs are going up. One of the other things that Liz Truss was saying all the way through her campaign is she didn't like green levies, and if we took those off electricity bills, then everybody would be much better off. Green levies, though, fund things like the renewable operation certificates and the fixed in tariff subsidies that the government's locked into for decades. So there was a bit of worry that they were going to try and break those contracts, and that would have been a bit of a disaster for all sorts of reasons. But at the moment, it's looking like they're going to knock the green levy off the bill, but then fund them themselves. So instead of the consumer funding it, the government's going to fund it. I think that's a bit of an odd situation, and I can't see how that's going to persist for the long term, but we'll wait and see what happens. But at the moment, there's no change to the subsidies regime, so we don't have to worry about that. There's lots of stuff in there about how the UK needs to boost its own domestic generation, but no real commitment to do much on renewables. It's all around oil and gas and shale gas and nuclear. And the cynical person looks at the Prime Minister's record at Shell and goes, well, she's just trying to encourage our mates. But yeah, it's not particularly helpful, especially if you made comments about solar farms and things. So that's maybe not helpful, but they're not actively discouraging new investment in renewables. The big thing, though, is that they are progressing with what they call energy market reforms, and this is going to be the big thing, I think, that's the NEVs. So this was launched by the new Chancellor back in July. Something that they've been talking about for a while. So the fundamental problem is that the price of electricity is set by the marginal producer of electricity, and in the UK, that is gas plants. And as gas prices have gone up, that's driven up the marginal cost of electricity, and that's the reason that we're all in a pickle. So renewable energy companies are making out like bandits, and there was a worry that they were going to be subject to windfall taxes. And the government said, well, yes, that's possible, and they'd be talking about that, but then they ruled those out. But they do realise that the whole way that the market operates is a bit strange, and therefore it needs to be reformed. So they've launched this consultation. It's still open. It doesn't finish until the 10th of October. I'd be surprised if they brought that forward and legislated on something before that's concluded, but it's not. It is possible that they will do that. One of the things they want to encourage is developing more storage. So battery asset funds should still be okay and doing well. And it's interesting this week that Renewables Infrastructure Group invested quite a lot of money in new battery storage facilities, but they don't actually come on stream for quite a while yet. One of the proposed ways of fixing this is to operate more on this contracts for difference basis. So this is the way that the new subsidies have been operating since about 2015. So I'll show you some examples in a minute, but basically they give you a fixed price for the power you produce. That's inflation linked, which is obviously helpful in the current environment. And that inflation linked fixed price lasts for 15 years. To the extent that power prices are above the level that you fixed your power prices at, you pay the money back to the scheme. To the extent they're underneath it, you get subsidised. So basically, project developers are bidding in projects at prices that they believe they can earn decent return on. So it's a kind of more of a cost plus basis, much more like the old regulated asset base idea of how to price utilities. Bluefield and Next Energy both had solar plants that made bids in auction round 4, which is the thing that concluded early this year, and actually won subsidies on that basis. So these plants that they've got here will operate on this CFD basis. So the clearance prices for these things are actually not bad. These are 2012 prices. This is one of the archaic things that they do. rather than using current ones. But I think I worked out that 45 quid was about sort of £57 in today's money. And that compares to baseload price this morning of about 283. So you can see how much cheaper these things are than the current baseload prices. And as I said before, they're indexed to inflation, which is sort of not bad news. So there's a lot of talk. There's not much that's definite, but large renewable producers are apparently sort of suggesting that they'd be happy to swap the old-fashioned ROC contracts that they've got for new fixed-price contracts under the CFD scheme. Where the big question is, what is the price going to be? It's not going to be the clearance price that we had here in auction round 4, because those ROC schemes were developed when solar installations were more expensive, and they priced in that they had much higher returns than those returns that from auction round 4. So I think we're talking about fixing in prices higher than auction round 4, and there's a question mark about whether people will moan, why did I lock in these lower prices when I could have waited and done this? So we'll wait and see how that pans out. And obviously, in the meantime, at the moment, the renewable energy producers are busy selling power on short-term fixed price arrangements to off-takers, and they're getting much higher prices. So Bluefield, the acquisition that it did in May, they were getting £180 a megawatt for the power that they're producing, but only for a couple of years. That runs off, and then it would roll back over again. So this final slide for me. This just shows, and this is an old one. This is Bluefield. The green line is what it was projecting in terms of where electricity prices were going in June 2021. And you can see at that point, prices are already starting to rise a bit. So it was saying it's going to get higher prices in the short term, but then they would decay quite rapidly and decay to levels that were a lot lower than it was assuming back in 2020, which are the blue and the black lines here. And that decay, if you remember going back a year or so, was starting to weigh on the NAVs of these funds. Since then, we've had a sharp reversal. So these lines now are way up here. So in terms of what they're earning, a lot higher than 60, 65 megawatts, pounds a megawatt. So, and the decay rate, so how quickly the power prices return to normal, that was becoming extended. So people were going out now into sort of 24 or 25 before things got back to normal again. But it might be, and I'm saying this is definite might, and just something to watch out for, that some kind of agreement is struck where for 15 years, these funds can take power and sell it up here, 60, 65. The difference it would make to any of these would be enormous. You could see a big jump. Other people I've read about, they're really quite pessimistic about this, but I can't see the industry signing up for anything that doesn't actually give them a benefit. Otherwise, they'll just say we want to keep the old arrangements. It's a question of watch this space, but I think in the coming weeks we are going to find out what's going to happen. So we should put that up here for a bit while we introduce Joe, and I think I've got him here. Good morning.
Yeah, James, can you hear me?
I can hear you. That seems to be working. Good. So I'll just answer a couple of questions before we start talking to you. Decoupling energy from gas seems to make sense right now. Doesn't it undermine the whole concept of privatising the space in the first place? I'm not going to get into that debate about whether privatisation is a good idea or not. We'll do that for another day. Renewables are much cheaper. Can government move things forward by tackling NIMBYs and onshore wind? I think the government's just not minded to do it. It's one of these strange things. It's something I've seen commented this morning. Is that why they think people are going to be happy having shale gas extraction plants on agricultural land, but have a problem with putting a wind turbine on or a solar panel plant? I don't understand, but that seems to be an issue. I think this government is not particularly renewables friendly. That's my impression. Are you topping up your renewables then? I will fess up and say, because I didn't have a clue what was going to happen when Liz Truss started, I did actually sell some some Green UK wind just ahead of this. And now I'm thinking I might have regret it, but we'll see how it works out. Anyway, enough from me. As I said, let's now talk to Joe.